serving as the faculty director. Great. I have the privilege of serving as the faculty director of the graduate tax program here at NYU. And one idea that they came up when I assumed this role a little bit over 2 years ago was the idea of having an annual meeting of the New York State Bar Association tax section, the Under 10 Club, here at the law school, so that members of that organization would have a chance to, well, I should really say our students would have a chance to interact with members of the Under 10 Club. So I'm really grateful for that. So with that, I just really want to welcome everyone, and I'll turn the floor over to Rick Tobin. And again, really appreciate your willingness to do something here on campus every fall. Thanks so much.
Thank you, Brant, for that. And, we love doing the event here. And I mean, lovely space, lovely place. I know I'm an LLM grad myself, and I think many in the Under 10 are as well. So for everyone who doesn't know me, I'm Rick Tobin. I'm the current chair of the NYSBA Tax Section Under 10 Club. I'm joined by Ron Moore tonight, who is the current vice chair, and who will be replacing me in a couple months. For those who have not attended an Under 10 Club meeting before, often they take the form that this is, which is essentially a presentation by an associate who worked on a NYSBA tax section report, answering questions about the report and also just presenting on it more generally. Today's speaker is Rita Halabi, an associate at Proskauer, who worked on the recent NYSBA tax section report on section 6418, which relates to the transferability of certain energy tax credits. I think something that more and more of us are seeing in practice, given how generous, well, I would say generous the IRA was in this regard. If you could please hold your questions until the end of the presentation, we'll do a Q&A. If you're attending via Zoom, you can type your questions into the Q&A box, and we will read them at the end of the presentation. Before I hand it over to Rita, I just want to say that if these presentations are something that you find interesting or helpful, I would, of course, encourage you to join the tax section and to join Under 10 specifically. We'll be sending an email out to everyone who attended this event with instructions on how to join. I think that's it for me. So without further ado, I'll turn it over to Rita.
Let's see if this works. I'm very bad with technology. So thank you, Rick and Brant, for the introduction. I see there are quite a few people here today. I guess it was a good idea, after all, to stand outside and say, live comedy show, live comedy show. Well, this presentation is going to be the exact opposite of that. So if you're here for the comedy, please leave now. I would recommend the intersection of West 3rd and McDougal. Okay, so back to the presentation. Very bad with technology. Maybe it will get me fired one day as well. Okay. Very confused. Okay, I think maybe it's a bit better. Okay, so as Rick said, this is a presentation on the NYSBA tax sections report on the proposed regulations to section 6418, which relates to the transferability of certain energy tax credits. Next slide, please. I'll start the presentation with an overview, a bit of background, and some statutory highlights about section 6418. And then the main part of the presentation, I will discuss 4 main issues addressed by the report and the report's recommendations with respect to those issues. And then finally, we'll have a Q&A session. Next slide, please. Okay, so Section 6418 was enacted under the Inflation Reduction Act, which contained a significant number of energy and climate-related tax provisions. The purpose of this provision is to facilitate the market for renewable energy investments, and it does so by allowing project developers to monetize the value of certain tax credits by selling those tax credits to third-party investors. To use these credits, you have to have incentive and tax capacity, which means that you have to have sufficient federal income tax liabilities in order for these credits to be valuable. So historically, project developers without tax capacity have entered into arrangements called tax equity structures, which were generally partnerships, and they would enter into these structures and allocate the credits principally to the third-party investors that have the tax capacity. Can I hold this? It will feel a bit more natural. Okay, good thing there are not that many people that I know here today. Okay, so the issue with the issue with the tax equity structures is that they were very complex and costly, and they would result in a lot of the funds going to lawyers and project promoters instead of to the projects themselves. So the intention is that Section 6418 would replace the use of tax equity structures. Next slide, please. So a key theme in the report was this tension between energy policy on one hand and tax policy on the other hand. On the one hand, with respect to energy policy, the purpose of this statute was to facilitate investments in renewable energy. So that policy goal would be better served by rules that would promote the marketability of the credits and allow them to be sold at the lowest discount as possible. The reason for this is that if the credits are sold at a lower discount, it means that more of the subsidy goes to the project developers, and this is more efficient from a fiscal perspective as well, because every 100 cents on the dollar that Congress gives up or that the government gives up, more of that actually goes to the underlying project. But on the other hand, Congress decided to pursue energy policy through the tax code, and it placed Section 6418 in the Internal Revenue Code. So Congress either knew or should have known that the statute would be interpreted under general tax policy principles, even if the application of those principles would have a negative impact on the marketability of the credits. And so there were a lot of conversations among the authors and the commentators on this report about the trade-offs between energy policy goals and tax policy goals, but ultimately the report's authors decided to take the approach that because the NYSBA tax section's expertise is in tax policy principles guide its recommendations. However, the report identifies certain areas in which Treasury may decide that the countervailing energy policy would override and would provide for a variation of the rules. Next slide, please. So I just wanted to point out a few highlights of the statute. This is not an exhaustive list. It's just a few things that were important for purposes of this presentation. And so very generally, as I said, Section 6418 allows an eligible taxpayer or a transferor to transfer all or a portion of its credits that are eligible for transfer to a transferee solely in exchange for cash. And this is a really important point, that the statute explicitly treats the transferee as the taxpayer for purposes of this title. And the next point is that the consideration for the credits is neither included in the transferor's income nor deductible by the transferee. There are also some rules related to the recapture of credits, which I will discuss in a different slide. And also there is the so-called no second transfer rule, which prohibits successive transfers of credits once they are transferred to the transferee specified in the election statement. Next slide, please. So the first issue relates to the application of Section 469's passive activity loss rules. Very generally, Section 469 prevents certain taxpayers, namely individuals, closely held corporations, personal service corporations, from using losses and deductions generated from passive activities to offset income from non-passive activities. So a passive activity is one that involves the conduct of a trade or business in which the taxpayer does not materially participate. And material participation means being involved in the operations of that trade or business in a way that is regular, continuous, and substantial. So just for the NYU students, a bit of history. These rules were enacted in the 70s and 80s when there was the tax shelter industry, and high income professionals like lawyers, especially fancy tax lawyers, would use their passive real estate losses to shelter their professional income. Next slide, please. Okay, so Section 6418 doesn't actually state that the passive activity loss rules apply. However, recall that the statute explicitly treats the transferee as the taxpayer for purposes of this title. So, and this title includes, with respect to the 11 credits that are eligible for transfer under Section 6418. So the proposed regulations accordingly take the approach that the transferee is required to take into account the passive activity loss rules in order for the transferee to determine how much of the credits it can actually use in a taxable year. And very importantly, the proposed regulations conclude that the transferee does not own an interest or materially participate in the activities that generate the credits, and therefore the transferee is treated as engaged in passive activities, and the credits are passive in the hands of the transferee. Accordingly, the transferee is only allowed to use the credits to offset passive income. Next slide, please. So this was the biggest issue for the report because the application of Section 469's passive activity loss rules would severely limit the number of market participants that would actually buy these credits, because there are not many taxpayers that have sufficient federal income tax liabilities that are from passive income that would make these credits valuable to them. And so there were a lot of conversations about how to interpret the fact that the statute treats the transferee as the taxpayer. One interpretation was that it's for all purposes, the transferee would be treated as the taxpayer, and therefore, since they can use the credits, they are also subject to all of the limitations on the use of those credits. Another interpretation was that the transferee would step into the shoes of the seller, the transferor, and accordingly, the transferee would be considered to materially participate in the underlying activities and should be able to use the credits. But ultimately, the report's authors decided that as a matter of tax policy, yeah, these rules should apply because this is a purely financial transaction, and the transferee, the investor, is simply purchasing credits. They're not involved in the underlying project, and so it would be a better reading of the statute for these rules under Section 469 to apply. However, the authors did acknowledge that if they did apply, this would really frustrate the statute's underlying energy policy because very few taxpayers would actually be able to use these credits. And so the recommendation of the report was that based on the principles of statutory interpretation, the rules should apply. However, Treasury should consider providing exceptions to taxpayers that actually materially participate in the underlying projects that give rise to the credit in order to balance the energy and tax policy goals. Next slide, please. So the second issue is the no second transfer rule. And this comes from the statute itself, which states that an eligible credit can only be transferred pursuant to a transfer election once. However, the statute and the proposed regulations are both silent on when that single deemed transfer or that when that single transfer actually occurs. And the preamble to the proposed regulations simply states that taxpayers should apply the common law test, the common law benefits and burdens of ownership test to determine whether federal income tax ownership has been transferred. Furthermore, the preamble explains that with respect to secondary market transactions, an intermediated or a dealer transaction would violate the no second transfer rule because the dealer would take transitory ownership of the credits. However, a brokered transaction would not violate the no second transfer rule as long as the broker never takes transitory ownership and the credits are never passed to any taxpayer other than the transferee. So here's an example. What happens if a project developer hires a dealer to sell the credits to a transferee, and the dealer enters into a binding commitment to purchase the credits if this dealer is not able to find a transferee to purchase the credits? The dealer never takes transitory ownership. Does this transaction violate the no second transfer rule? Well, you would have to apply the common law benefits and burdens of ownership test to figure that out. And so those factors include the right to possession, the duty to maintain and insure the property and to pay federal income tax, to pay taxes on the property, the passage of legal title. And so this is a test from the case law, and it really applies more to property and goods. So next slide, please. The authors of the report thought that this test was not really helpful to determine whether or not the credits have been transferred, because as I said, they're more relevant, these factors, for the transfer of goods and property. And these credits are neither goods nor property. They just represent the right to use the right to reduce your taxes. And so it would be helpful to have a clear rule on when the transfer actually occurs. The issue is that it's not clear what Congress intended by enacting this rule. And so that makes it difficult for taxpayers and their fancy tax lawyers to determine what other factors would be relevant and whether these transactions on the secondary market, as the example I provided, would violate the rule. And so ultimately, the report's authors recommended that the Treasury issue rules based on what Congress's intent was behind this rule. And it provided two examples, that if Congress intended to make the statute more administrable, then the rule should be based on the literal reading of the statute, which is that once the credits are transferred to the transferee specified in the transfer statement, then no successive transfer should be permitted. However, the report's authors acknowledge that if this were the rule, then yeah, a limited secondary market would arise as a result. Alternatively, if Congress's intent was to prevent a secondary market from emerging, then it should simply provide a clear rule when the transfer occurs. Next slide, please. Okay, so this is my favorite issue in the report. And that's because it's the first one I worked on, and it's the one I spent the most time thinking about, especially one particular Sunday when my friends were out in Chelsea eating paella without me. It relates to the credit recapture rules. So there are two main there are two main recapture events provided for in the proposed regulations. The first is if the property eligible for investment tax credits is sold, disposed of, or is otherwise no longer eligible for the credits, then there is recapture under Section 50A. If there is a net increase in non-qualified, non-recourse financing with respect to that property, then there is recapture under Section 49. The first type of recapture comes from the statute itself because it references the recapture rules of Section 50A explicitly. But the second comes from the proposed regulations, which simply state that the passive loss rule, which simply state that the at-risk rules under Section 49 would apply. And so the very important thing to note here is the way the recapture burden is allocated. The default rule is that the transferee is liable for the recapture burden, and even if it's actually the transferor that caused the recapture event in the first place. The statute itself does not actually state this, but Treasury took this approach because Section 50A treats the taxpayer, requires the taxpayer to take it into account, and Section 6418 itself says that the transferee is the taxpayer for these purposes. But another thing to note is that the preamble states that the parties are not prohibited from contracting to indemnify the transferee from the recapture burden. Next slide, please. So this was the big issue for me. The special rules for the partnerships and S corporations. This is a variance from the default rule in how the recapture liability is allocated. So if the property eligible for credits is held by a transferor that is a flow-through, and a partner or shareholder in such transferor sells or disposes of its interest, then the Section 50A recapture is borne by that partner or shareholder. If there is an increase, if there is a disposition or a change in non-qualified, non-recourse financing at the partner or shareholder level, then that partner or shareholder is liable for the recapture burden under Section 49. So you see there's a variance here. While the default rule requires the transferee to take into account the recapture liability, the special rules for partnerships and S corporations impose the recapture liability on the person, the party that caused the recapture. And so next slide, please. I spent a lot of time thinking about how unfair this rule is, because if the transferor is the party that causes the recapture, why should the transferee be liable? It's the transferor that sells the property or makes it ineligible for credits. So why should the transferee have to bear that burden? Yeah, admittedly, there is a limited solution provided for in the preamble, which is the indemnification of the transferee. But doesn't that just add another layer of complex negotiation and cost? To me, it feels more like a Band-Aid that doesn't work very well. But an additional issue is that because of this seemingly arbitrary difference between the treatment of transferors that are flow-throughs and that are not, there's going to be a change in the market where it's likely that purchasers will prefer purchasing these credits from transferors that are flow-through so that they can avoid the recapture liability altogether and not have to engage in contracting for indemnification. So the report's authors believe that this is unfair and to subject the transferee or a party that is not responsible for the recapture event to the recapture burden. And it would have recommended, the report would have recommended that the party that's responsible should be liable in all cases. However, it acknowledges that Treasury might believe that it is bound by the statutory reference to Section 50, and and also in that the statute treats the transferee as the taxpayer. But the report's authors believe that there was not an explicit requirement by the statute itself to impose the recapture liability on the transferee. And also, importantly, Section 50 was enacted prior to the ability to transfer the credits. Next slide, please. Okay, so the last issue is how the proposed regulations deal with the treatment of expenses and losses. As I said before, the consideration is neither included in the gross income of the transferor nor deductible by the transferee. Well, what about expenses and what about losses? Expenses, lawyers' fees, especially fancy tax lawyers' fees, accountants, the losses, what happens if a transferee purchases a credit and then ultimately claims much less of that credit than what it paid for? That's an economic loss to the transferee. Should the transferee be able to deduct that loss? Well, neither the proposed regulations nor the statute provide any guidance, but in the preamble, Treasury asks for comments on these issues, and it prefaces the comments by saying that taxpayers should not be entitled to a double economic benefit absent clear congressional intent, which there wasn't here. So next slide, please. So this was also another very important issue for the authors and the commentators of the report, because there was some disagreement about how a certain statute would be applicable here. First, I will discuss how this relates to the transferor. Allowing the transferor to deduct the transaction expenses would result in a double economic benefit, which violates the no double benefit rule, which is a general tax policy principle. And in addition, it would violate Section 265, which disallows deductions related to the creation of certain income that is exempt under Subtitle A. So in this particular point, there is disagreement because Section 6418 is actually in Subtitle F, not in Subtitle A. So there was a question about whether Section 265 really applies. And then with respect to the transferee doesn't have tax-exempt income in the form of the credits. The credits are not income, but the transferee does get a measurable economic benefit by when it actually uses the credits. So this would potentially also violate the no double benefit principle. And then with respect to the losses to the transferee, so investors that buy tax-exempt bonds are permitted to take losses, economic losses. And so it's not unheard of. And admittedly, allowing the transferee to take economic loss deductions would actually be better for the marketability of the credits. And so there was a lot of disagreement about how to deal with that tug of war between energy policy and tax policy. But ultimately, the authors of the report thought that even though Section 6418 is not in the Subtitle A, there's no policy reason to treat these expenses differently, and even further, the no double benefit rule would apply here, and therefore the transferor should not be able to take the deductions. And the report recommended that Treasury issue rules under either 6418 or Section 265 to make it clear that the transferor cannot take the deductions. With respect to the transferee, the report's authors believe that disallowing the deductions would have a greater impact on the price, which would affect the marketability and which would maybe go against the energy policy goals. So it thought that Treasury should come up with a rule that it thinks strikes the right balance. But if it does decide to disallow the deductions to the transferee, then it would be symmetrical to disallow the deductions for the losses as well. Next slide, please. Okay, so does anyone have any questions? Should we?
Yeah, hi. Thank you. So I had 2, 3 questions. One was on the issue, on the issue of the expenses. So I read the report. So what we're saying is that the transferee does not take the expenses because it's exempt technically, the amount that they're receiving for the transfer of the energy credits. But subsequently, when there's a recapture event, we at that relevant point of time, we take the expenses because at that point in time, there's no, because they're going to pay taxes on it. Now, my question was that timing, won't it matter? Because let's say there is a recapture event, basically the IRS kind of determines that this is not the amount of ITC that you're going to get. You're going to get a lesser amount. But I, as a developer, would want to contest that. So when do the report does not talk about at what point of time will I wait for the crystallization of the recapture event, or would the notice be good enough for me to kind of then claim the expenses that year?
Well, I think the way that the report approaches the expenses is that they're separate from the actual underlying credits. So they're not related to the credits at all. And with respect to the recapture, that's taken into account in the taxable year in which the credits are used. So the timing doesn't necessarily have to be the same.
No, I'm talking about the eligible taxpayer. Basically, the eligible taxpayer,
So sorry, so you mean the transferor?
the transfer.
Mhm.
So the expenses towards that amount which they're receiving, since that entire amount is not taxable. So because of 265, which you mentioned, there'd be the allocable expenses or apportioned expenses will not be allowed that year. Now, let's say there's a recapture event after 4 years, and the recapture event is only by virtue of a notice by IRS. So it's not crystallized per se. So if, let's say, the indemnity clause in the M&A says that, no, you have the right to kind of also litigate that matter.
Mhm.
But at that relevant point of time, the liability is not crystallized, but yet for all purposes, the indemnity clause kind of kicks in. So at that relevant point of time, do I claim expenses at that point of time, or do I wait for because let's say they say I've claimed ITC of $50, let's say. Now they say that no, it's $30. Now I litigate, it comes down to $45. So I can still technically have overclaimed in the year when they have said it is $30, the amount of expenses. And then do I need to again go back when, let's say, I win in the courts to say that, oh, it's all right to claim $45. So, when does this expense really crystallize for the transferor?
So if I understood your question correctly, I think it's a really excellent question. You're right. We did not address that issue at all in the report, and I don't think that we even discussed it. But I would like to think about it a bit more. I could try to give you an answer, which is maybe because the expenses are separate and because the transferee is actually under the default rules, assuming you meant that the transferor is not actually a flow through, correct? It's not a flow through. So in that case, the transferee is subject to the recapture, okay? And the expenses to the transferor are completely separate. And so are you asking,
Because the indemnity clause then kicks in. So
right,
they kind of paid it at that point of time. So the report
right.
mentions about indemnities not getting taxed, allowing that as an expense to
Mhm.
the extent of not the penalty. But I'm also asking about the earlier losses which I have not claimed, or the earlier expenses which I have not claimed. Right now, that should kick in irrespective, because I'm not technically I'm paying taxes on that amount now. But but let's say the indemnity clause also has, which technically always has, that I have the right to litigate it. So I'm litigating
Right.
it, and I now, from let's say from a $30 goes up to $45, I win in court and gets crystallized at that relevant point of time. So there is no way of me going back again and saying that no, I have now claimed higher expenses, or let's say lower expenses, whichever would be the case. Or let's say from $30 comes down to $20 by litigating in court. So I mean, technically, when do I crystallize those expenses? Or wouldn't it be a better policy just to allow expenses for the time being and kind of, I mean, even though it's a double deduction, since they're allowing transferability as a separate, is it that's not better to allow deduction because of this timing issue? Otherwise, or not allow them to litigate. I mean, either way, it's going to be difficult. That's what I wanted to know. I mean, how would you do it in an M&A transaction?
Well, I guess in an M&A transaction, you would, and again, this would add to the complexity of the negotiations, because you might have a provision that states that in the event that this is not going to be treated as an eligible credit, and there is a recapture, you would just use the draft. You would just draft about this. But I don't know. I think in other cases with respect to other expenses, you would just deal with it by treating it as it's required to be treated in each taxable year. And in the event that there is a recapture, so the amount is no longer taxable or no longer tax exempt, then the pro rata amount of the expenses to what was recaptured, maybe you can try to claim a refund for that and state that the credits were recaptured. But again, with respect to the default rules, it's the transferee that has the recapture, right? So it's the transferee's issue. The transferor already took the expenses. So feel free to reach out to me just to make sure that I understood your question correctly.
Yeah, I mean, the complexities will increase with, let's say, flow-throughs then.
Right. Thank you.
Thanks for your talk. One question I had, wondering if you could talk a little bit about the kind of overall policy behind you talked a little bit about there being a kind of a tension between having a liquid market for these and then some of the regulations that sort of cabin and maybe make the market a little bit less liquid. And kind of, I'm curious what your thoughts are as you were preparing the report and helping draft it, particularly kind of in light of a general presumption that we have in tax law against the marketability of tax attributes. I mean, there's very few provisions in the code that allow for that in the first instance, and this is sort of an exception. And so I'm wondering, how did you think about that overall policy presumption with respect to tax law as you were making recommendations to Treasury on these regulations?
So thank you. Great question. My views were a bit different, I think, than some of the report's authors. And I really believe that this was pursuing energy policy through the code, and the code was simply a mechanism, and the underlying energy policies should prevail. Obviously being tempered by certain tax policy principles where appropriate. But I think my own thought process was that where we can help the taxpayer to promote the marketability as much as possible, that would actually be better for Congress's energy goals. But ultimately, that's not what what everyone thought. There were some commentators who really strongly believed in the energy policy issues, but I think most of the authors and commentators thought that this may not be the most efficient way to pursue these policies, and we're tax lawyers and this is in the code. How can you assume, unless Congress specifically said so, that the Section 469 rules wouldn't apply or that the at-risk rules wouldn't apply? If that's the result that Congress wanted, then it should have explicitly said that. But our rules of general statutory interpretation would say that when we're interpreting the code, we're interpreting the code with general tax policy principles. So yeah, it was truthfully very difficult to think about the issues and to think about how to come up with a rule that strikes the right balance, because you can't divorce the statute from the code. But at the same time, if we're trying to promote a robust market for the credits, then why are there all of these limitations that really restrict the market and would lead to substantial discounts? Meanwhile, it's really inefficient as well from a fiscal policy. So yeah, I guess the short answer is that I struggled with it a lot, and I know that there were a lot of disagreements between the authors and commentators about this.
Strikes me there's a tension here in terms of what are the goals of the Internal Revenue Code, especially with respect to this provision. So thank you.
Hi, thank you for your presentation. Okay, I have sort of a more basic question, just checking sort of my understanding. So when you have a recapture of these credits, the transferee, does that recapture result in income in that year or the year that they originally used the credit?
Okay, so great question. And truthfully, I did not go into the details of how the recapture actually works. So I'll start with that, which is, so when a recapture event occurs, and let's assume that we're talking about recapture under the default rules. When that event occurs, the transferor, who again caused the recapture event, has to inform the transferee and provide the transferee with enough information for the transferee to calculate how much is going to be recaptured. And then the transferee takes into account that recapture on its income tax returns in the year in which the credit is claimed. And then the transferee also must notify the transferor about how much was ultimately recaptured, because the transferor has to increase its basis in the underlying property because of the recapture.
Thank you. And I just have a follow-up question too, touching on the same thing. So why, I'm not sure I understand why there's special or different rules for pass-throughs. Like what's the background there of why that exists in the first place, that you have a default rule and then the exact opposite for pass-throughs?
So yeah, it's a great question. This is something that the authors discussed pretty heavily, and a lot of us were scratching our heads about this. And ultimately, we came to the conclusion that the reason for this was that it's very difficult for the transferor, that's a flow through, the entity, to control the actions of the partners and the shareholders, which are the ultimate owners of the entity. And so it just, from an administrability standpoint, it just made more sense to have the shareholder of the S corporation or the partner be liable for the recapture. Like, admittedly, and this is something that I thought about, that if we wanted to apply a single rule across the various types of transferors, then maybe you can have LPAs or LLCAs that require a partner or a shareholder to inform the rest of the partners when it wants to dispose of the interest, or you could have restrictions on increases in non-qualified, non-recourse financing, but it might be too complex. And so it seemed like this special rule for the partnerships and S corporations was just an easier way to deal with that complexity.
Thank you.
Hi, thank you. I am just a little curious about the discount you mentioned. Is there sort of an established market standard when it comes to valuing the credits? Maybe this is more of a broader deal question than a tax question. Just curious.
Yeah, actually, there is now a what the practitioners believe is a standard price for the credits, and this was as of a few weeks ago or a couple of months ago even. They're saying that the credits are being sold in the market now for 90 cents on the dollar, but who knows if that's changed since then. And so, yeah, 90 cents on the dollar is, I guess, not so bad for Congress in comparison to 60 cents. But yeah, did I answer your question?
That's good. Yep. Thank you.
Thank you for your great presentation. Assuming the Treasury follows your recommendation about the timing of transfer, what type of structure or arrangement can a broker or investment banker use to trade in these credits?
Wow, I did not think about that. Thank you. Okay, so if the well, so it would depend, right? Because we recommended that Treasury come up with a rule based on Congress's intent. So if we said that let's interpret the statute literally and allow for a limited secondary market to emerge, then who knows? I mean, maybe we should call PwC and figure out what kind of structures they would come up with. But really, I would see that there would be a lot of possibilities as long as, yeah, I would see a lot of possibilities, but I wouldn't be able to draw them for you. I'm sorry.
No matter. Thank you.
I was curious, in the old partnership flip structure, do the passive activity loss rules apply to the partners in that structure?
In the old partnership flip structure.
Right. So in the before transferability was a thing.
Oh, okay. So in a tax equity structure.
Correct. Yeah.
Okay, so great question. And they wouldn't apply actually to the third-party investors because the investors would be treated as owning an interest in the underlying project. So they wouldn't be considered passive credits in the hands of those third-party investors.
Yeah, that's interesting. If these rules are supposed to broaden the availability for these credits, that limitation would apply. I don't know. Just a thought that I had during your presentation.
So yeah, so I agree. And actually someone said that the application of 469 maybe would disadvantage taxpayers in comparison to the tax equity structures. And this was one of the reasons, because 469 wouldn't apply to the third-party investors, and the same would be with respect to the expenses. There, the investors would be able to deduct the expenses.
Kate, are there any questions from the chat?
No, we do not have any questions right now.
Okay. I think that will conclude our presentation then. For the people that are in the room, there are snacks and drinks just outside, and we'd encourage you to, come and enjoy. Thank you, everyone.